Hello, everybody, and welcome to the show today. So I'm really glad you could join us because this is one of the most interesting topics that I've ever had an opportunity to discuss on the podcast. And I've rarely ever had an opportunity because this is such a niche, such a powerful niche that you can make such good money in. But at the same time, there's so few people in the country that do this. I mean, I know like very few people in the country that do this. And so I wanted to bring on the foremost expert in this. And I mean, when we talk about the volume he does, you'll see that he is the guy that knows this space better than anybody, and decode it, tear it apart, and see what's involved where you can make money in a really cool real estate niche that not a lot of people are in. It's kind of a secret that a lot of people don't know about. So with us today is Kris Benson. Now, Kris is the Chief Investment Officer for Reliant Investments, a subsidiary of Reliant Real Estate Management. Now, Reliant Real Estate is one of the top 30 commercial self-storage operators in the U.S. in 2018. Now, as Chief Investment Officer at Reliant, Kris is a member of the company's investment committee that is responsible for overseeing the company's new acquisitions. He's also responsible for investor relations and working with accredited investors to raise the capital needed for Reliant's acquisition of new self-storage properties, which, by the way, they just got one right down the road from me, which we'll talk about later. So Kris is an investor in commercial multifamily as well as commercial self-storage and currently has over 570 units in his portfolio. While commercial multifamily is a great asset class, he believes the opportunity right now is in self-storage. I believe that too. And in the last 12 months, the Reliant team has invested over $96 million in self-storage projects and raised over $38 million. I think that's right, from investors. Self-storage provides a unique opportunity to invest in one of the most successful asset classes in the last 5 years and take advantage of the institutional interest moving forward as well. So Kris, thanks for joining us today.
Thank you, Todd. Appreciate the opportunity. You got to take a breath there. That's a lot of sentences all at once.
A lot of people say that. They go, man, you never take a breath. And I'm like, I feel weird when I have to pause to take a breath. So, but I'm really
well done.
Everybody that listens knows I get like freaked out, pumped when there's just something that I think is so cool and I'm passionate about. And I love what you do in self-storage, man. I just think it's brilliant. There's not a lot of people in the space. There's a lot of ways to monetize on what you guys do. I love what you do, man. I think it's awesome.
Oh, I appreciate that. Yeah, it's an incredible asset class. I think the thing that you hit the nail right on the head is there's still so much opportunity that exists in the asset class. When you say not a lot of people are doing it, just a quick statistic for your audience and for you. There are 6 publicly traded companies in self-storage, right? There are 5 REITs, and then there's one publicly traded company. It's called U-Haul. Everybody knows who they are. So they own about 20% of the entire self-storage market, 20, 25, depending on what data you look at. The rest is up for grabs, right? So there are companies like us. We have 48 properties, including that Lutz property that you just mentioned. So we have 48 right now, but you know, there are a ton of mom and pop operators. And for your listeners who know real estate, you know, typically mom and pop operator, they own 1, 2 properties, and there's huge opportunities for revenue enhancement in those types of properties. So yeah, it's a great asset class. We've been fortunate to be a part of it. I'm part of an awesome team at Reliant who really has a deep understanding of storage and how to make it work. And yeah, I've been happy to be along for the ride.
So let me start with that. I mean, why do you like self-storage as much as you do? And obviously you hit on a major point, right? Which is why one of the reasons I love it. It's really niche. There's just not a lot of players in this space. It's space you can get into and make ridiculous money without a lot of competition. But beyond that, what are some of the other real benefits that you love about this asset class?
So I think there's 3 pillars, right? And we just talked about one of them, and I would call that pillar opportunity, right? It's the opportunity to roll up. And to say there's not a lot of competition probably isn't fair. I'll walk you through kind of what's happening in the asset class now. But there's 2 things I think when we look at an asset class to say, hey, is this an investable asset for us? The first thing is returns, right? Everybody wants to talk about how has the asset class performed. And so I'm going to reference a data set, and I can actually send you the link to the data so your listeners can see it as well. There's a data set called the National Association of REITs, NAREIT, and they track all of the publicly traded REITs across any of the real estate asset classes. And they track it for a long time. So they have 25 years plus worth of data, right? If you look at the REIT data and compare major asset classes, self-storage, retail, office, apartments, you know, you can look at timber, healthcare, anything that has a publicly traded REIT, you can see here. Storage in the last 25 years did just under 17% a year. It was 16.85% a year, which is incredible. And so, everyone, I would say the darling of commercial real estate investing is always multifamily, right? Because people have lived in apartments. They understand how that model works. Multifamily did just over 13 in that same time frame. Still incredible, but self-storage outperformed it. So that's the first thing we look at is, okay, historically, how has it performed? The next thing is returns are fantastic. What happens in the last downturn? We're a believer, and I think most people are, that everything's cyclical, right? So you're going to have a downturn, and you want to understand how these asset classes get affected in those particular real estate downturns. So from 2007, 8, and 9, you can look at that same data. In 2007, 8, and 9, stores lost less than 4%. Pretty good. Apartments was just under 7. Retail got crushed. Office got hurt really bad. S&P 500, just for baseline, was down 22%. So you look at an asset class where, Warren Buffett's rule, number one in investing is don't lose money, right? So you look at an asset class that has performed well over time and have some downside protection. Those were the two things that really stood out to us. And then the last part about it that you just talked about, or that we just talked about, was the opportunity aspect. There's still so many opportunities for a business to go into a mom and pop operator and create value in a property. And in multifamily, and I have a fair amount of experience investing in multifamily, those opportunities are very, very challenging to find right now. So, I think where we are in storage's life cycle is every asset class goes through this life cycle of it kind of is in its infancy and grows to sort of a mature. And we're sort of in that phase now where people after 2007, 8, and 9 said, oh, we should be looking at storage because it did so well in the recession. So and back to my point about the competition. So in the last 2 years, 2017 and 2018, the industry has delivered the most net new rentable square foot in the history of the asset class. So there's been a huge development cycle of new properties coming online. And 2019 is going to be that way as well. So it'll be interesting to see how that gets sorted out with the demand, right? It's a supply and demand game with all this new supply coming to market, how it gets leased up. And then look, the next market correction is going to be a big opportunity because there's a lot of people in this game who don't know storage, and they've just seen the performance of it and said, hey, I'm a developer. I'm going to build a storage asset. And that's, as you know, when the blood is in the streets, that's the time to buy. So we're anxiously awaiting what the next correction looks like for sure.
One of the things you mentioned there was, how you were able to come into an existing operation and help them monetize in ways they haven't before. And that makes sense with multifamily because there's not a lot of ways you can monetize. Mm-hmm. But let's talk about that. When you come into a new location, what are some of the things you guys are doing to start monetizing that location that typically they're just not doing now?
Mm-hmm. You're saying specifically for like a mom and pop operator?
Sure. I mean, for mom and pop, you come in, they're selling it for whatever reason. You obviously are coming in and seeing an opportunity to monetize and make even more money in multiple different ways. What are some of those ways that you're able to come into a property and monetize from what that mom and pop has been doing on their own?
So in that forced appreciation or value add category, there's really two separate paths here, right? One path is, construction, right? When we say value add, most of the time we're doing some sort of expansion, right? So you may be mom and pop operator, you're in a great market. We believe the market's undersupplied and we have the ability to expand. Maybe you built a 40,000 square foot facility, you ran it for 10 years, you're ready to get out. We look at the facility and say, hey, we can build another 25,000 square feet, get that leased up, right? And the valuation is all based off rental income and net operating income. So if we can grow the NOI of the property, we're also growing the value of the property. So that's one way, is through construction, expansion, putting a shovel in the ground. And then the second way is ancillary income items. And I'll give you an example of the property that's just down the road from you. So that was a property that was bought by, or was originally purchased by a guy and his brother. They built it in the late 90s. They've done a fantastic job. They did 2 or 3 expansions along the way, and it's in an unbelievable location, as you know. The area it's in is growing leaps and bounds, ton of traffic. So we went in, looked at that site, and for example, if I was a tenant that started renting a unit in the year 2000 and I'm still a tenant today, I pay the same rent. He's never raised rents on
19
tenants
years?
who've been ever.
That's
So
ridiculous.
you may have a 10 by 10 unit, right? 10 by 10 storage unit, and there's 15 different rates of who pays what for a 10 by 10. So if you rented today, you're going to pay more than that guy who rented in the year 2000, but he's never raised rents, right? These are his people. Like, the owner loves the business and he's in it every day. And so there are all kinds of examples like that where just going in and running it like a business, right? I mean, you have to cover your expenses, right? Our expenses are up at least 3% a year. So, that rent growth has to support that expense growth. We're not in the business, or our investors aren't in the business to lose money. So, that's one thing. There are some ancillary revenue items in storage unique to storage that don't exist in multifamily. Things like truck rental, right? You go in, we're one of the largest U-Haul dealers in the country. We have U-Hauls on all of our sites. Most people who are using storage, they need a truck to move their stuff. So U-Haul, we can build a commission structure off that. Tenant insurance programs. So our leases require, and some states require, that tenants have their own insurance for their belongings in the unit. So we offer tenant insurance if their homeowner's policy doesn't cover those types of things. So there's revenue dollars available there. Point of sale items, locks, boxes, tape, those kinds of things. When you come in our retail space, we can create some revenue there as well. So I would say on average, our ancillary income, probably 10 to 15% of our portfolio revenues are driven off those ancillary items, aside from just the rental revenues that you'd expect.
Wow. And that's impressive, because there's, like you said, there's a lot of ways to monetize. What's interesting is one of the biggest and most important ways that you said to monetize was expansion. The guys down here did it, Lutz, and you talked about that property. I'm in Trinity, Florida. Lutz is right up the road. I mean, I pass it on the way to my office and I see that storage facility. You talked about it, I immediately know what it is. But one of the big things you said is those guys expanded a couple times. You come in expansion. Kris, can I be honest with you? That sounds expensive. I mean, the numbers that we're even talking about here, that you guys invested over $96 million, $38 million raised from investors. I mean, this is a big game. So how do people get into this without the experience, without having the millions to do these things? Because you guys kind of help with that aspect as well, right?
Well, I mean, I think there's two paths, right? When you decide to be a real estate investor, you decide to be one of two things. You're going to be a direct investor, which means, Ty, you're going to go out, buy a facility, figure out how to manage it and run it. And that's an option, right? And it's how we got started, right? It's how basically every real estate company ever got started, right? There's someone who's, well, it's all about what you want to do, right? I'm a big believer in this, Ty, is the only thing not replaceable in this world is time, right? And I'm also a big believer in the 10,000 hour rule. So if you want to make money in real estate, you got to be an expert. And there's only so many 10,000 hour blocks in your life. If you want to dedicate a 10,000 hour block to be a real estate expert, man, there's a huge opportunity. Most people that we deal with anyways say, hey, I know why to invest in real estate. There's tax benefits, right? There's return and the appreciation of my capital. And I like investing in a non-correlated asset to the stock market. But I don't have the time. I'm a doctor. I'm a lawyer. I'm an executive. I have disposable income and I'd like to invest, but I want to do it passively. I don't want anything to do with the property. And really, Ty, that's who we partner with the most. When you talk about that $38 million in equity, that's done with our investment partners. People who are saying to us, look, we want a piece of the asset class. We'd like storage. We'd like you, Reliant, and your track record, which is key if you're doing any type of passive investing. You're trusting the operator with your money and you have no say. When we talk about being a limited partner, you're trusting us to do everything and any limited partner. So what I would guide your listeners to do is the big piece is doing due diligence on the operator. So we can give you access to the asset class. You just want to make sure that you're partnering with someone when things go wrong. What are they going to do, right? Because everybody's friends when things are good, right? Everybody's having a great time during the sales process. We're the greatest people ever. It's when things go wrong that you find out who you're partnered with. So we partner with a ton of accredited investors who have interest in becoming passive investors in the asset class. And that's worked out really well for us and our investor base.
Do you guys deal with only accredited investors or non-accredited as well?
Yeah, so for us, we only deal with accredited investors. There's some SEC regulations, and not to get too far down a hole, but there's some SEC regulations around the type of offering that we're doing. Typically, we're doing a 506C offering. In those 506c offerings, it has to be you have to be an accredited investor. And just a quick definition for your listeners who don't know what that is. So accredited investor, there's two tests that allow you to be accredited. One is a net worth test. Essentially, you have to have a net worth greater than $1 million, excluding your primary residence, or it's an income test. And in the income test, it's for single income, $200,000. For dual incomes, it's $300,000. You have to have made that in the last 2 years and expect to make it in the future. So those are the tests. And actually, as part of our investment process, as an investor goes through our subscription documents, there's a step that we have a third-party verification that verifies, hey, this person's accredited so they can have access to the deal.
You help them if they're not accredited already?
In what way?
Well, I mean, let's say somebody comes in, meets the requirements. They're not officially an accredited. They haven't been certified or passed what they need to do. Do you guys help them with that point to become accredited?
Oh, absolutely. Yeah. It's a checkbox, honestly. Like it's actually built into our investment process. So there's a third-party website, or we have a letter that you can send out to your accountant, attorney, financial advisor who can verify for you. So yeah, that verification process is super easy.
Sure. And that's nice that you do that, because once they're accredited investor with what you're doing, then they're an accredited investor. There's a lot of different things in the SEC that they're then able to go out there and do.
No question.
Yep. So that's cool. So if you don't mind me asking, and I'm sure you have a pretty good idea of this, what kind of returns can somebody really expect? And I think in the beginning we talked about the kind of returns in the asset class in general, but with your clients, what kind of returns does somebody see where they would want to invest in something like this versus something like the stock market? And then let's talk a little bit more about the stability of something like this versus the stock market. Again, in the beginning, we kind of generally talked about this, but narrowing it down to kind of what you guys see in your organization with clients with returns, things like that.
Yeah. Well, so I think the easiest way to do that is I can only speak to our track record, right? So there may be other self-storage operators that have outperformed us or underperformed us. I gave you the National Association of REIT data because I think that's a good baseline for all of the publicly traded REITs. But so for us, as I had mentioned, we have 48 properties, primarily in the Southeast. We've sold another 21 properties. So that's our track record, right? That's where we've gone full cycle with investors and returned capital and appreciation. So our average rate of return is just over 65% a year. So what we're saying to investors is if you had invested at the project level, the project has returned just over 65% a year, and our average hold time is just over 3 years, right? So that equates to just under a 3 multiple. So if you had invested $100,000 into one of our projects and you could have invested across all 21, the average return on that we would have returned to you just over $293,000. Now that's inclusive of your principal. That's inclusive of all the distributions throughout. But keep in mind, Ty, it's an incredible rate of return, right? We've done an excellent job, but we've also been part of the greatest real estate market of my generation. I'm 39, right? So for the last 10 years, if you had your money in real estate, you really had to work hard to screw it up, right? So we're a great operator, in my opinion. I'm biased, but we're a great operator. But the second part of it too is, the market has come with us, right? Rising tide floats all boats. So what I would say is the deals that we're underwriting, and then we're in the midst of raising money for a fund right now, the average rate of return that we're saying all in when we sell the properties is 16% a year. And we're projecting it to be a six-year hold. So, that total ROI, we'll use the $100,000 example again. If you invested $100,000, we're projecting when we're done in 6 years, we're going to give you $196,000 back to you. That make sense?
Yeah. I mean, it's phenomenal. You're basically doubling your money in the course of about 6 years is what you guys are saying.
Mm-hmm. Yeah, that's what we're projecting right now. And look, we feel like we're being pretty conservative, but Ty, as I mentioned, and I don't mean to harp on it too much, but the wild card in all of this is the next correction. Everybody's been saying, hey, it's coming, and it is. It's an inevitability. We're in the United States, we're in the greatest or the longest bull run that we've ever had. So it's coming. It's just a question of when.
Well, and let's talk a little bit about that and risk. And then I want to get a little bit more into your general overall strategy of buying and holding and what you keep and those type of things. But let's talk about that. I mean, from your guys' perspective as operators in the space, What do you foresee coming? You know, do you foresee a major correction economically? Do you a minor one? I know you're not an economist. I'm not asking.
Yeah.
But I am interested to see.
If I knew that, Ty, if I knew that, I wouldn't be selling self-storage. I'll tell you that.
Well, like I can tell you as a company what we're doing proactively now to prepare for the correction. And I can tell you that we don't believe it's going to be a major correction like we saw, 2006, 7. But I am interested from your guys' standpoint. You're obviously preparing for a correction. You're talking the language now, acknowledging that, it's probably going to happen. We know it is. We know that we're going to see an adjustment. From your guys' perspective, how much are you guys preparing? Do you really foresee that there's going to be a major correction sometime soon? Or do you think it's going to be like what we've seen in the past before this 2006-7 insane debacle that we saw?
Well, I think the challenge with 2007, 8, and 9, right, was the correction was twofold. It was not only the markets correcting, but it was also debt. Debt went away. Credit went away. And in your business, you knew that, right? That's how you created a business out of it, is good real estate operators, no one could go get debt because the banks said, nope, we're done. We're going to see what happens here. And so this is my own personal belief. It reflects nothing, and it's not really rooted in data either. It's just my gut. There's going to be a valuation correction, 100%, right? That is going to happen. What I think is going to be different than 2007, 8, and 9, I think the banks have been smarter where they're not going to be in a position where debt locks up, right? So for companies like us, that's much better. We're in a position where there's still debt to go and credit to go get, whether that be from a debt, vehicle, equity vehicle, it doesn't matter. That's my own personal perspective. If you're asking strategy, how are we approaching it as a company to mitigate those risks? I think there's two things, right? You talk about risk as an investor or risk in real estate on a whole. How you lose your money is the bank comes and takes your property, right? Otherwise, the property always has an intrinsic value. It may go up or down, right, based on market valuation, but it's always worth something. The dirt is worth something. It's never zero, unless you lose your property to the bank. The bank takes it, now it's worth zero. You've lost your principal. So I think for us, it's being very conservative in our debt that we're putting on these properties. Like the fund that I had mentioned that we're raising now, it will be less than 70% loan to value, meaning we have 30% of equity or more in each one of the deals in the fund starting. So if there is a correction and we have to go out and get additional debt on one of these properties, there's a pretty good bet that we have enough equity where a lender is going to feel comfortable. The second thing we're doing, aside from being conservative in our debt, is that's why value add for us is the strategy we're moving with now versus development. Is we feel like value add, think of it this way, right? So if I start at 70% loan to value, which just means for your listeners, if it's a $10 million project, it's worth $10 million. The bank says, hey, we're going to give you 7. Reliant, you got to come up with $3 million. 70% is debt. Okay, so we go out, put $1 million into it, and build another 15,000 square feet, and I'm making up the numbers, but 15,000 square feet of storage, we get it leased up and stabilized. Now our property's not worth 10 anymore. It's worth, 15, right? So now my loan to value, right? I still have that $7 million loan. My loan to value is less than 50%. In that case, Ty, unless there's a catastrophic market correction, we got more than 50% equity in our project. It's really hard for us to imagine that if we're in trouble and we have to go get a new bank loan, that there's not going to be a bank out there who wants to lend on that type of product. So that's kind of how we're looking at it, right? Conservative loan up front, forced appreciation model on the side, and build out additional equity so that we're in a position where we can go get debt if we need it. That's how we're looking at it for the correction. But, there's a lot of unknowns here for sure. And I follow a few economists, they're saying the next 2 years, they don't know. Nobody knows for sure.
Well, and I appreciate your insight because I just like talking to really smart people and figuring out those two things. Like, what do you foresee and how are you preparing? Because I lost my business in the first crash. I owned a mortgage company. I was right there on the front line of the whole thing. And so obviously we do really a lot of proactive things. So I appreciate you sharing that. And I don't hold your feet to the fire. I know you're not an economist, but I was going to ask about risk and what the risk really is. And what I like about your strategy, what I love about it is that not only does it allow you the ability to go get more debt if you need to, but you can unload those properties at 50, 70% loan to value too. Even if the value drops and you had to get out, you could get out because that equity's there. So it sounds like you've got multiple different ways that you're kind of offsetting the risk. But what kind of risks does an investor really face getting into this if they're investing money into self-storage?
Well, we just hit on the worst one, right? Investors always ask me like, hey, what's the worst case scenario? Worst case scenario is you put in $100,000, you lose it. There's no way you lose more than that, right? So if we ever have to make a capital call, the project needs more money, the investors aren't on the hook for that. We'll go to them and say, hey, Mr. Investor, we need another $1 million to keep this project afloat. Do you want to reinvest? If they say no, we have the ability to essentially go out and get additional money, and it dilutes them, but there is no obligation for additional capital calls. So worst case, the bank takes the project, we lose our $100,000, or you lose as an investor, you lose your $100,000. We just talked about how we're mitigating that. I think the other risks in storage is back to the supply side. That's our biggest risk right now. When we go into a market, storage is very micro market specific. What really matters is the 3-5 mile radius around your facility is where your tenants come from, right? Storage isn't like apartments. People aren't going to drive for a good school district, right? I mean, it's a garage. So it's got to be convenient to your house or convenient to your work. If it's not, you're not going there. We don't have amenities other than customer service. We feel like we offer a superior customer service, but other than that, it's a garage on a cement pad. So what we're really focused on in our acquisition strategy is buying into markets, one, that we feel are in a position where they can absorb some new development, right? Because most of our investments are in a 5 to 7 year hold period. There can be a lot of development that happens in that time frame, right? A lot of bad things can happen in 5 to 7 years. And what we're projecting now, based off the data we have today, may be different 3 years from now. So we're looking for markets that can maybe absorb some of that new development, and that we feel like is undersupplied at this point. And measuring the supply in storage, I don't want to take up too much time talking specifics about it, but measuring the supply in storage it's a moving target. It's not a perfect science to say, okay, if there's this amount of population, then this is how much storage there has to be. So for us, I think that's the second risk, is as an investor being thoughtful as to where we're getting into for additional supply to maybe impact our ability to hit our projections, right? Because we're making a projection saying, hey, we think we can grow rent so much. We think we can, drive occupancy by this much. Well, a self-storage facility opens across the street. That's going to impact our ability to do those things, right? It's basically supply and demand. So I think that's our second biggest risk right now, is just the supply side, and it's tailing off. 2019, we've had a development curve that's looked just like this. 2019, or the end of 2019, it does this, and 2020, it's supposed to tail off. So we'll see sort of how this development settles out in the marketplace.
Yeah, and I like that. I mean, there's multiple ways you're really covering risk, because you're like, look, the worst that happens is you put your money in, you lose your money. But in order to lose your money, you basically have to stop paying rent on that property. Like, they have to foreclose.
You got it.
I mean, and in order to foreclose, like, there's a million things that can happen before that point happens, because you're in these with the right equity. So if you're in a position where you couldn't afford the property, which doesn't make sense because you're buying them that cash flow anyways, I would imagine, like, you're getting into properties that cash flow and you're improving the cash flow of them. But even if worst case scenario happened, you're in enough equity where you could go borrow money more to take yourself through. So the risk is really minimal with the way you guys do it, which I think is just brilliant.
Yeah, I mean, we hope so. We've been we've never lost investor principal. We've never made an investor capital call. So far the strategies work. But look, and I don't mean to hedge against us, but nobody backs 1,000, right? If you're in real estate long enough, like people say, oh, they foreclosed. Well, if you're in this game long enough, it happens, right? I mean, things happen. And now if you foreclose on 15 properties, well, maybe that's an issue. But let me give you just a quick example. One of the nation's largest private self-storage REITs in the early mid-2000s built up a portfolio of over 200 projects. He lost 100 to the bank in 2007. And, he sold the other 100 for a couple $2 billion. And now he's rebuilding. He's back up to 150 properties. So it's not like, they don't know what they're doing, but there are risks in the marketplace that some you can affect and some you can't. And so, as your listeners hear this, right, it's not perfect, right? It's not like no one ever loses money in real estate. They absolutely do. but you take the risks, you try to mitigate them the best that you can, and try to be forward thinking and conservative in your estimates. And, and then you see what happens to the market, because that's the big piece that nobody really knows.
Chris, what is your overall investment strategy? You touched upon it, and it sounds like you're buying a property, you're then doing these improvements, and we talked about what improvements includes, and then you mentioned 6 years. So is that really your goal, is to get in, do improvements, and then flip it for a profit every 6 years?
It depends on the project. There are some projects and markets that we could see ourselves being in forever. The property that we just bought by you, that's one we feel has long-term legs just because of what's happening around it. But for our investors, right, we're making a projection of when we think we're going to get their money back, right? So in a situation where we may say, hey, we think this property has legs, we don't want to sell it. We're going to try to do two things, right? One may be, if we built up the value of it, refinance it, right? Because you as an investor, if I give you back your principal, let's say you invest $100,000, we're in it for 5 years, and we say, hey, Ty, we don't want to sell this thing. It's still cash flowing fantastic. We think there's still upside in the market. But what we're going to do is we're going to refinance it. I'm going to give you your $100,000 back, and then we're just going to collect coupons after that, right? Because now your principal's back in your pocket. You can go invest in something else if you so choose. But you're collecting your cash flow every quarter, right? Which is a win, because your return is infinite. You have no money in the deal anymore, and you're still making money. So that's the magic wand scenario where, that's as good as it gets. But there are definitely properties, 21 properties where we've sold them, and our average hold time on those is 3.15 years, right? So on those 21 sold, it's just over 3. So we're projecting that 5 to 7 years. I mentioned the fund is a 6-year projection, but we're opportunistic. If there is someone who wants to buy the product that we have, and we're able to get our investors the returns we promised in year 6, but we can do it in year 3, we're going to do that. Let me give you just one quick example of that. We built a facility, ground up development in Naples, Florida. We expected to hold it 6 to 8 years. It was going to be a flagship type property. Beautiful, 3-story glass, stone. We opened it. It took us about 12 months to build. We opened it and ran it for about 8 months. Got an offer from an unsolicited offer from one of the storage REITs. And they basically gave us the value that we had projected in year 6 in year 2. So we said, okay, right? So for the investors in that position, the investors tripled their money in 2 years. We can't walk away from that, So I think it's a project by project opportunity, but I would say that we're opportunistic in that, hey, if we can get that money out short term, we will, and vice versa, right? If the market craps out and goes down the tubes, we're not going to sell the property for a loss, right? How the comp structure is built is our incentives are aligned with our investors. So we don't make any money if the investor doesn't make any money. So obviously our incentive is to make sure the investor makes their money first, then we get to share in the profits.
What kind of investment are you looking for from an investor?
So typically our investment minimums are $50,000 of either cash, but we have a lot of investors who do self-directed qualified funds. So like a self-directed IRA, self-directed 401k, that type of thing.
Cool. And then, and that's awesome, because I think we talked about a lot of the other things with kind of returns they can expect, exit strategy, those type of things. So it sounds like for the most part, you're trying to get an investor out and paid a few years into it. 3 years, 6 years?
Well, I would say you plan on 7, and if we can get you out earlier, great. And that's the thing where I went back to, you're really trusting the operator to make the right decision, because you have no recourse. If you come to me year 3 and say, hey, I'd like my money, by law, you're signing on the document saying that's up to Reliant to make that decision. You don't have a voting right in that. So, it's what we say to our investors is this is money, and you're getting dividends along the way. It's not like, the money goes away and 6 years later we show up with a check. Most of our projects and the business plan is different for each, but there's a dividend that gets paid every quarter to you based on the cash flow of the properties. But this is money that investors should look at as long-term, right? Hey, I don't need access to the liquidity. And that's really one of the downsides to these private placements is it's an illiquid investment, right? You can go buy a share of a storage REIT and it's perfectly liquid. You could trade it today, buy it today, trade it tomorrow. With us, you buy it today and you wait for us to tell you we sold it. And here's your check back. So, it's just kind of as an investor, you got to know what you're getting into and what you're comfortable with. And, that's how I counsel our investors to say, look, it's a long-term play that's illiquid. So if you need this money, don't do this deal with us.
It's cool. Anything I really haven't asked that you think that it's important for the listeners and viewers to be able to know about investing and stuff? So we kind of took a different angle here because, what I really want to know is how to make money on this without doing the work. And we probably could have talked for a long time about doing the work and the exact steps that were involved in what you guys do. And there's a lot to it. But anything else along that line that maybe we should have talked about or should have asked that I haven't?
No, I mean, I think if the plan is to be a passive investor, right? The key is, and this isn't just with us, the key is, and I've done a lot of passive investing in other asset classes as well as the stuff we've built on our own. The key is the people. You're investing in the people. And usually if you can make a good decision around, character and work ethic of the people you're investing with, the deals turn out pretty good, right? Because in these types of offerings, these private placements, you are trusting implicitly the operator. And a great operator can take a bad project and make it okay. And a bad operator can take a great project and make it awful. So, my advice to your listeners is if you want to be a passive investor and you're looking for these types of investments, there's a number of places you can go to access those deals. There's crowdfunding sites like CrowdStreet, Realty Mogul, Fundrise. There are private placements like us, right? So an investor can reach out to us direct and say, hey, I'd like to learn more about that. But the thing that you want to do your due diligence on is the people, because ultimately they're going to be the ones that make these things work through the good times and the bad times. So that would be my advice. And I try to push that to everybody is do your due diligence on the operator, make sure they know what they're doing. They have a track record of success because it's the best indicator of what's going to happen in the future is what they've done in the past.
Kris, where can everybody go to kind of learn more about investing in self-storage, what you guys do, these type of things?
Yeah, for sure. So I have a website. It's krisbenson.com with a K. So it's KrisBenson.com. I have a LinkedIn page that I'm pretty active on. Kris Benson, if you search Kris Benson Reliant. And then for the specific to the business, we have www.reliantinvestments.com. And that goes through a lot of our track record information on the firm, that type of thing. On krisbenson.com, there's going to be a number of educational videos as well where you can see, walk through some of the terminology, those kinds of things, just kind of free content. And really, we built it so that I have a place to send investors so they don't have to ask, right? Where someone can go through a learning process really high level and say, okay, I'm dangerous now. I at least understand how to evaluate these types of opportunities.
Cool. Kris, thanks for coming on with us, man. This was really enlightening.
Yeah, I appreciate it, Ty. Thanks for the opportunity to chat with your listeners. And let's talk soon.
Sounds good. So everybody, make sure you do one of two things. Either go to KrisBenson.com. That's KRIS Benson, BENSON.com, KrisBenson.com. I'm going to put the link on the show resources page. Or you can also go to ReliantInvestments.com, a Reliant, RELIANT, investments with an S.com. And I will make sure that and Kris's LinkedIn is on there as well. And I'll put their Facebook link there as well so you have all those in the show resources page. Guys, that's pretty crazy. I mean, an opportunity to nearly double your money in up to a 7-year time frame while you're still getting dividends or in the process. That's pretty cool thing to do, which is why that they attract so many investors, so much money. And I didn't ask Kris, but I imagine most of their investors, Kris, most of your investors probably come back and reinvest, I would think, right?
Yeah, especially the ones who've been part of the 21 sales, right? I mean, that's our goal, is to churn that money as quickly as possible so that you come back and say, hey, what are we doing next?
Yeah. And in a model where it's driven a large part by investors' money, you've got to make sure those investors get really good rate on return. And that's what these guys do at Reliant, is they're coming in and making sure you're getting really good rate of return. So you want to constantly reinvest. Makes it easier on them. They have to find fewer investors that way if they blow your socks off. So I think this is brilliant. I love self-storage because it's such niche. Not a lot of people are really in it. And Kris was very humble and said, look, there is competition, but if you really look at the real estate investment space in general, multifamily, residential, it's insane how many people are investing there, considering the very small percentage here. So it's a lot of opportunity. And Kris talked about a lot of different ways to monetize self-storage facilities as well, and ways you can make additional money on properties that are already cash flowing, from raising rents to selling more things to be able to expanding the property. I think it's just a brilliant way to go. But to be honest, it's cumbersome to learn to do this by yourself from the ground up. There's so many things involved and so much money and capital that's required that it's for some people. And if that's not for you, then this may be a better way to go, to actually be able to passively invest without having to do the work. So make sure you check out ReliantInvestments.com or KrisBenson.com. Both of those are on the show resources page. And as Kris said, all the details you need are there. You can learn enough to become dangerous just by looking at a lot of the training there. So make sure you check out KrisBenson.com or ReliantInvestments.com. And again, everybody, I'll put those on the show resources page. Thanks, everybody. Have a great day.